Hello everyone, I hope you're well, hope you're doing alright. So, this is a series where my newest students who still don't know the in and outs of my system, don't know my refinements, my optimizations, exactly how I trade, they decide to take trades in the beginning of the mentorship, in the first session basically, and send me those trades, and therefore I'm going to evaluate them right in front of you guys and tell you what the student is doing right, what he's doing wrong, so you learn from their mistakes. So let's get right into it. The student sent me this GBP USD trade. Now, the idea for this trade, let's go to the 6 hours, is that the market right here, as you can see, it grabbed these lows. Okay, let's remove everything except I don't want to remove the position. I want to show it to you. And let's go to how my student created this analysis right here. He created this analysis right there. Okay, right here. So what he saw on the charts is the following. He saw that the market created a lot of bottoms right here through to the downside. He saw that the market came down right here and grabbed their stop losses through to the downside, boom, and then it started pushing through to the upside. So he was like, you know what? The market just grabbed the stop losses through to the downside, and therefore I believe that the market is going to push through to the upside and grab some stop losses through to the upside. Now, where is the area to the upside to be grabbed? He marked these stops right there, and he said, you know what? Right there, this is what he did. He marked these stops right there and said, you know what? We have these stops right here. Their stop losses are all the way up there. And therefore, I'm going to aim for this target. Okay, this is how he built his analysis, and he said that he wants to be bullish for GBP USD all the way up into this line right here, which is a great analysis at this point of the chart. Right here, when I click the replay button, this is a great analysis. However, let's move forward towards what ended up happening. Let's move forward. So let's look at the live markets now. Okay, so this is where he created his analysis, right here, boom. Now, the market is right here. So let's look at what happened. What happened is that the market created some further areas of liquidity right here. Look at this. 1, 2, 3, right there. By creating all these tops below this high, we make this high a major carrier of stop losses. So this high right here becomes a major carrier of stop losses through to the upside. The market pushed into that major carrier of stop losses, then started reversing from there with all these bearish candlesticks right here, a huge volume to the downside after tapping into that major carrier of stop losses. We came all the way down into where? We came all the way down into creating liquidity right here through to the downside. So you see what's happening here is that the market created stop losses, boom, grabbed them, pushed through to the downside, and now is starting to create stop losses through to the downside. Where's my line? Right here. Okay, so the mistake that this student did in terms of bias analysis in that case is he analyzed the charts right here, determined that the bias in the beginning of the week, that was Sunday, as you can see, my vertical line. So in the beginning of the week, he determined that the bias is all the way up into here, and I just simply didn't look at it anymore. He didn't update it. Okay, it's bullish. He had that bias. Now everything that seems bullish to him is just fixated in his head, that the market is going to be bullish, that the market is going to push into this area, that the market is going to just push up there without updating his beliefs and his biases and his perspectives about the chart. If he just came back later and looked at that bias again and asked himself, is the bias still the same? Do I still have the same bias for that trade? Before he took it, just that, then he would have realized that the market right now is in a dangerous area if we just grab the stop losses through to the upside and we're creating stop losses through to the downside. So I don't want to be participating in such price action. This is the way that he should have thought. Now, he didn't. He moved down to the 30 minutes and he said, you know what? I'm bullish, I'm bullish, I'm bullish. I'm just looking for this bullish trade. And he saw that big ass push to the downside right here that confirmed his beliefs, because he was like, oh, you know what? The market pushed through to the downside right there and it grabbed these bottoms. It grabbed this bottom right here. It grabbed this trend line. So it grabbed major areas of liquidity right here and then pushed through to the upside and indicated a reversal. So up until right here, if I draw this vertical line right now, we have determined that the market grabbed liquidity through to the downside and pushed through to the upside. Okay, great. Now we're going to continue pushing through to the upside because we just grabbed all the liquidity through to the downside. But again, what did he do? He did not analyze the price action on the right side of the chart, which is, okay, yes, the market grabbed liquidity right here. However, the market pushed down right there, all the way down into the beginning of that, the end, I mean, of that impulse right here through to the downside and created bottoms with it. So we created more liquidity right here through to the downside. And then we started pushing through to the upside. Right now, the market is reacting to some news and to the market. Basically, it's right now 10 a.m. and therefore the market is reacting through to the upside. However, I don't believe that this trade will cross this area right here. He's seeing it from a 30 minutes perspective, which is, okay, the market grabbed liquidity through to the downside and is now pushing through to the upside. However, the higher time frame perspective, which is the 6 hours perspective, is saying the exact opposite story. What it's saying is, it's saying, okay, we just grabbed liquidity through to the upside and now we are pushing through to the downside. This is what the 6 hours story is highlighting. And therefore we need to abide by our biases. Okay, well, what is our bias at this point? And if you reanalyze the bias, you realize that the market is creating major liquidity areas through to the downside and you just grab this major liquidity area right here through to the upside. And therefore this is what we should be focused on, basically. And therefore, going through to the 30 minutes right now, the market is pushing in his direction. He must be very happy at this point when taking this trade, as the market is pushing in his direction. However, he decided to hold until 1 to 3 risk to reward ratio, which I don't believe that the market will make it up all the way there. I believe that the market right now, at any point right here, let's say in this area right there, the market will just reverse and tackle his stop loss through to the downside, and he won't be very happy about it. So that's the evaluation for that trade. That's the mistake I believe he made. He didn't, so the major mistake is that he didn't recheck his bias. He checked it in the beginning of the week and he said, okay, you know what? We are bullish. And he just stuck to that. And throughout the whole week, he's looking for that one bullish trade that's going to make him money. And this is emotional thinking of, I don't want to recheck my bias so I don't get proven wrong, basically, or nothing changes or all that. So no, you need to recheck it and verify whether anything changed, because the whole bias could change and you could change your opinion about what's going to happen in the market. Another reason why people do this as well, by the way, it's because of ego. What I mean by that is, in the beginning of the week, for example, someone will analyze the bias, then he would tell the people around him or his followers or whoever it might be, he'll tell them, for example, hey guys, listen, I believe GBP USD is going up, or I believe GBP USD is going down. And therefore, when the market provides data that this is not going to happen, actually, he refuses to read this data because he already put his reputation on the line and he already told everyone that the market is going to go up. So he feels ashamed to change his opinion after like 3 days before he stated that the market is going up, and that ego plays a huge role in taking wrong trades. And therefore, this is why I believe, while this is, yes, pushing up through to the upside right now, that it is going to stop and reverse and take out its stop losses. And this is going to be an ego mistake of, I said something and I want to stick to it. No, a great trader is a trader that can change his mind. You read the data of the market and you react to it. You don't make predictions and stick to them. You react to whatever information and data the market provides you. That's it. And this is what you should stick to. So guys, as you can see here, the market pushed a little bit in his direction right here and then pushed with volume in the opposite direction. Tackled his stop loss and tackled the stop losses right here on the 6 hours. The lesson for the day, there's 2 lessons actually. The first one, when the market speaks, a good trader listens. So you don't just talk and cast your judgment on the market on what you believe should happen, and then you stick to that. The market is speaking. It's printing new price action. It's telling you new things, and you need to listen if you want to be a good trader. And therefore, that's lesson number 1. Lesson number 2 is you always stick to the higher time frame story. Because right here, even though this is something that we didn't talk about, the market grabbed liquidity through to the downside, as you can see, and then pushed through to the upside. And therefore, this created some bullishness right here. So if someone was just analyzing the 30 minutes, they would say, okay, you know what? I could be bullish right here because the market grabbed liquidity and then is now pushing through to the upside. And therefore, okay, the market is reversing. I need to enter some bullish trades right there. And therefore, a good trader also follows the whole story of the market and isn't enticed by small time frame price action. If your higher time frame is saying that you are bearish and then your lower time frame is saying, okay, look, I might be printing a bullish price action right here, you listen to your higher time frame. So a good trader is someone who listens to the whole story, isn't just enticed by smaller time frame price action, isn't enticed by his brain wanting to be in a trade, because this is all it is. If you're ignoring your higher time frame, if you're ignoring your story just to rely on this small time frame price action, it's because your brain wants to be in a trade. He's like, okay, no, I shouldn't take it because I'm bearish on a higher time frame, but you know what, I'm bullish here and I want to be in a trade, so why not? What if the market retraces? What if something happens here? And therefore your brain is trying to convince you that, hey, I want to be in a trade, so why don't you enter it? This doesn't seem like a really bad idea, and therefore you need to fight those instincts, those basic structures of your brain that push you to be in trades, and you have to listen to the whole story. As you listen to the whole story, you'll know, okay, you know what? I am bearish, even though this is enticing me to be bullish right here. However, the whole story is saying bearish, and therefore I'm going to stay away from the charts. So lesson number one, recheck your bias. Lesson number two is always check the whole story. Do not be enticed by lower time frame price movements. And guys, if you liked that video, let me know in the comments so I create more of it, and I'll see you in the next one.